Hi guys, my name is Pops. Some call me also Pavalo. We're going to be talking about candlesticks today. What makes a candlestick and the importance of a candlestick in a chart. So, in your normal candlestick, you will find two things. You will find a body, and you will also find a shadow as well. So, what makes a candlestick made of a body and a shadow? And the other thing, the importance of the candlestick in our life or in trading is that candlesticks help us to market and tells us where the market is going. So you have this normal candlestick here, a bearish, the bullish candlestick, sorry. In this bullish candlestick, you have this part called the body, and you have this part, this thin part here, it's called the wick or shadow. So that is the wick, shadow. This part here is your body. Now, when a candle is forming, a candlestick is forming, it has an opening handle, which is this part. The way we see that it's an opening or a close, it's where the wick and the shadow meet. So normally where you find the wick and the shadow meet, that is the opening, most likely to be the opening of the candle. Then you're going to also to have the close of your candlestick. It's where your candlestick body ends as well at that moment. So we're going to have the close right here. So the candlestick is made out of a body, a wick or shadow. It has an opening and it has a close. You're also going to have your bearish candlesticks, which are candlesticks that are moving down. Those are your bearish candlesticks. Candlesticks that are normally moving down, just like that. And you have your wick as well. So the wick and the bodies, they form different types of candlesticks in which we use to analyze the market, or the type of candlestick that we see. It's called price action. So let's go to our different types of candlesticks, and we'll be able to observe. Well, now in this picture, you'll see we have a big white candle, a big black candle. Those are your normal candlesticks. Then you're going to have your doji, dragonfly doji, and gravestone doji. Now remember these guys, that candlesticks are called differently depending on the institution, the resource, or the person you'll be learning from. But the formations and the shapes are the same. So some people will call it different names. That's why I say these ones, for me, they're just normal candlesticks. This one, the name is universal, is the doji, dragonfly doji, and gravestone doji. That's what we'll there. Now, the important candlestick in our role is the doji. The doji has so much impact in the market, especially when it has reached a major support or resistance zone or an order block, buy and demand zone. That's where now the doji. So the doji now normally present the reversal of a movement or reversal of a candle. So what do I mean by that? You're going to find that the market is moving up. The market is just moving up is our important supply zone, demand zone, or order block in this area there. Let's say that's our important supply zone, demand zone. Then the market starts to form OG in that area there. Now this tells us now that the market will be starting now the rich movement. We got our confirmation from OG at this zone. So that's how powerful the doji is. We use it. So you can imagine the market was moving up. Let's say we are on a weekly time frame. We are on a weekly time frame. Now, as we are on a weekly time frame, this will be the previous week, the next week, and we have the current week. Once it ends, once this week ends, market forms, then we know that the following week will start to going down. So we'll be expecting sales because of we've seen a doji supply or demand. So that's how the doji is important. Others here at this row, they are important, but they are important when they are followed by other candles, in which we're going to see that later. Now, all this that are in the middle row, you have your hanging man, your hammer, your inverted hammer, inverted black hammer. Like I said, depending on the institution or the person or the resource you are learning from, they are called by different names. Some people call them pin bars. Some people call them shooting stars. But I prefer hanging man, hammer. Sometimes I'll use pin bar. At the same. So the way that these ones are important, that in here, the way that these ones are used, I'll show you now. Oh, there we go. The way that these ones are used, you're going to get your, there we go. Just zoom in a bit. So you have your hammer. So the market was going down and a hammer happened, then the market started to go down. The market was going down, an inverted hammer, the market started to go up. The market was going up, the hanging man happened, and the market started to go down. The market started to go up, then a shooting star happened, then the market started to go down. Provided that the areas that they are happening, a support or resistance zone, it's your order block zone, or it's a supply and demand zone, must be an important price in the market. And that's where we will be confirming with this candlesticks, which is called price action, where the market movement is going. So all these candlesticks are the same. Some people call them pin bars, pins. Some people call them shooting star. You can see here, they say, but at the end of the day, it's hammer, hanging man, any weight that you are comfortable with when you are trading market. So as we go to our initial slide there. There we go. Now, as we come here, you're going to have the last row. The last row, you're going to have your spinning top, the shaven head, shaven bottom, and marubozu. So spinning top works the same way as the doji, just that the doji doesn't have a body. This one has a body. We get the top and we get the bottom. A shaven head works the same way as your hammers. It's just that the wig is a little bit shorter, but it works the same way as those ones as the shaven bottom. So because they work the same function with these two, so we normally usually call them your pin by your hammer because they still look like that. And this one, sometimes we refer it as the body. The main name is spinning top because it's a body. Then maribozu is just a normal candlestick that we use. Now, as you can see, here you have your hanging man. The market was busy going up, and it was an important zone here. The hanging man was created. It was a sign to show that the market will go down. The market was going down, up again, and a hammer happened here. Here they say shooting star, important reversal zone, and the market started to what we use information for the market going down as our candlesticks. Now you're going to have these other ones. Like I said, other candlesticks, they become more effective once they have partners, partnering candle. That's when we can read them and see what's happening when it comes to those ones. So at this point now, we are going to have at this point now, you're going to have all right, so you're going to have this engulfing bar at the moment there. So let me just show you. Now, engulfing bars, what happened is that you have your first candlestick. Let's say this is your bearish candlestick right there. Then you're going to have another candlestick engulfing this one, bullish candlestick. Let's say the market at this moment was going down. What you are going to have, you're going to have your candlestick there at an important reversal zone. Then the next candlestick is going to engulf the other one. Then the market will go up. So same way as you're going to have when the market is going up, then you're going to have your first bullish candlestick in reversal zone there as the market going up there. Then the one that follows bearish engulfing, it engulfs the and then the market down, provided that this zone. So normally you'll find them looking like this, and that's what normally people look for. But as you can see here in the picture, the candlestick size doesn't matter. The first one, as long as the second one engulfs it, longer than it, we identify this pattern as an engulfing zone. So now we are moving at our evening star, extended evening star. Now here it's multiple patterns. You can see you have your hammer, your doji, your hanging man. Then this is a normal candlestick just breaking that zone there, and it shoots down there. So normally this is also our construction phase, but because we are looking at the price action, you can see the market with you all the reversal patterns there, provided this area is an important A doji, as I explained before, the market was going up, reached the zone, and then the market now starts to go down at the same time. Now, as I said, the doji and the spinning top, they apply them the same. As you can see in your small picture there, you have a spinning with your doji right there. Now you have your evening star, which is your hammer. The market reached the important zone, went up, then started to shoot down. As the same way here, evening star, you can refer it as your spinning top as well. They have the same indication. The other important candle to notice, it's your inside bar candle. Inside bar is the opposite of your engulfing bar. So what's happening is that, let's say we have our bearish candle going down like this. As we have our bearish candle, now this candle is where it has started, the zone where it has started. The color. There we go. There's this zone where it has started, and this zone, the bottom of it. So between or in between here, you start to have candles, candlesticks in between those zones. You start to have candlesticks which are in between those zones. So now, let's erase this and put nice color. The market started to go up, but it's not breaking. It's not getting, these candlesticks are not becoming longer than this one. And because they are in between this area, this pattern is called inside bar. Now, when the market breaks up at the zone, and you have your breaking candle, confirmation candle, then we know that the market is really, really going up. That the market is same story when the market start to have bearish candles and breaking candle, confirmation candle, then we know that the market was going to now to shoot. So that is the concept of inside bar, referring to this candlestick right here. So it doesn't matter how many bars are inside of this. It can be one candlestick, it can be multiple candlesticks. Then the important thing comes when it breaks. Moment. So let's look at our picture again here. So here you have your long bullish candlestick, and you have a small bearish candlestick which is inside here. Then you have your breaking candle. As you can see, this candle all the way down as it broke the zone there. Confirmation candle, we know that the market moved down. As you can see, at the same time here, you had the candlestick, and this one's inside. So whether we wait for it to break, whether up or down, once it breaks, it gives us a confirmation of where the market really going. So the other one, you have your three outside downs, in which myself, I like to refer to them as your double top, as your railway. Refer to them as your railway. You have your bearish railway and you have your bullish railway. And you can see they are at your resistance zone and support zone, meaning that these zones are important. Now, the way you identify a railway, the candlesticks are almost the same size, same formation. They are almost the same, but it's not all the time that they are the same. So once this railway forms at an important price, we know that the market is. As you can see in this zone here, you had our railway forming right there at this important zone, important price, hit the bearish railway, and the market started to look down. So this was part of the signs, price action, that we see, or we will use to see that the market is really going down, provided that the area is an important zone. I'll repeat, provided that the area is an important zone. The reason why I am emphasizing this is because we do not trade candlesticks. We use candlesticks to confirm our analysis, but we do not trade. We use candlesticks to confirm our analysis. That's why I always emphasize the point to say, provided that the area is an important reversal. Now, as you can see, let's go back to what just we had our bearish, now we have our bullish. Now, our bullish is also the same as our bearish, just that vice versa. Here you have your hammer. The market reached an important zone, going up, reached the zone and started to going down. Reached an important zone and started to go up. Inverted hammer, the market started to go down or reach an important zone and started to go up. Same as your engulfing bars. Engulfing bars, it went down, the bearish candle and the bullish candle engulfed. Same story there as I explained before, just vice versa of the picture I was telling you about. So this is why candlesticks are important. If you hear somebody saying, I'm trading price action, this is what they are meaning that they use candlesticks to confirm where the market is going. So even us, we use price action to confirm where the market is going. But we do not trade candlesticks. We trade market structure, but we use candlesticks as well to confirm our analysis, especially when it comes to bigger time frames. So that is the end of the lesson, guys. So I hope you have picked up some things and hope to see you in the next lesson.